All right then. Yes, let's set up here. Okay, and you can see my screen, right?
Yeah, we can see the screen, yep.
Okay, perfect. Okay, so my name is Vince Doherty, and I'm probably one of the oldest members in this group. So I didn't find fire until I was past my 50th birthday. And when I did find it, I was like, oh, okay, this is what life is about. This is what finances are about. This is what personal finances are about. And I was fastly heading for my retirement age, and didn't have very little pension, had very little savings, spent all my money, and I made lots of money during my lifetime, but decided to spend it all anyway. Just like the good old-fashioned public and everybody else out there, most people out there, that's what they do. They go from paycheck to paycheck, and they spend their money and they earn money, and we're just in this cycle, right? So yeah, so I eventually found fire, and now I'm based in Ireland. You know, when I was doing all these searches, I was finding things about 401ks and tax efficiencies in US and everything else. So what I decided to do then was to set up this Financial Independence Ireland Meetup group in order to find other people who were interested also in financial independence. And at our first meeting, 6 people came on to that meeting, and I was thinking, this is great. People to talk to about financial independence. Brilliant. So I can share ideas, I can get information, and find out more about it, and I suppose entice me to carry on with it as well, you know. But the great thing about that is we actually ended up building a nice little community. I have these meetings now once per month. Well, they're all virtual now. We used to have them face to face, but now that's all virtual. And we get about 40 to 50 people every month now coming along, and we do little talks and chats and share information, Q&As and everything else. And then I started building then kind of a blog website type thing. Then is ignitemyfire.ie, in order to be able to share that information, because that's what I believe in, right? I believe in getting that information out there, showing people about financial independence. I didn't know about it until I'm, you know, doing this catch up right now, to having to put a lot of money into my pensions and everything else, just try and catch up to where I should be in order to be able to retire, right? So that's me in a nutshell. This is where I am. So Financial Independence Ireland, the Meetup group, and ignitemyfire.ie in order to get that information out there. But what I'm going to do now is I'm going to talk about tax efficient investing. Now, this is all based in Ireland, right? Because, well, that's what I know right now. So if you're in a different country, this may not be of interest to you, and feel free to listen in, and if you want to, but you know, this is very much based Ireland only. So each country, you know, has their own tax efficiencies, the way to defer, usually way to defer taxes until your retirement. And so let me just go through a few of those for you. Okay, so there's actually 4 different schemes. Basically, it's 4 different ways of efficiently investing in Ireland. So one of the most ones that the most powerful ones, in my opinion anyway, is the adding additional payments into those occupational pensions. There's a thing called the EIIS scheme, or EII scheme, sometimes people call it. There's forestry funds, and there's a rental room scheme. Now you will notice something that's missing out of that, right? So we have you would have heard of 401ks in the US, you would have heard of the ISA in the UK. We do not have these. There's a group set up, what's it called again? Is it a savings group or something like that, that are pushing for these things and pushing for more efficient investing in Ireland. So please do look those up. If somebody can remember the name of that, please put it into the chat. think it's called something like savings group or something. I can't remember, to tell you the truth. Okay, so moving on, just like Dave said, you know what, I'm not a financial advisor. Anything I talk about here is all based on the information that I found. Now, please do your own research. But all I'm doing here is passing information over to you guys, okay? So we'll jump in then to the occupational pension. All right, so anybody that has an occupational pension, so if you work, you're PAYE, most people do have a pension. If your workplace does not provide a pension, then they have to provide a way for you to be able to invest your money into pensions, right? As part of that, there's a thing called AVCs. And AVCs are basically they're additional voluntary contributions. So this is a way for you to put more money into your pension than what you would be putting in normally. Like, for example, if your employer provides a matching scheme, let's say a 5% matching scheme, so you put in 5%, they'll put in 5%, then you can actually put in more than on top of that. These are usually a pretty good way of, I think this is the most important tax efficient investing in Ireland there is, especially if you're on that 40% bracket. And the reason for that, we'll jump into it a little bit later, but what you're doing is you're saving 40% on your money almost immediately. Now, of course, it does go into a pension. It means that it's in there until you can start drawing money out. Normally it's 60 years of age, but it is possible to also start getting to it at 50 years of age as well. And there is, you know, some downsides as well. People do say, what if the government starts taxing it or start putting more into it? But the way I look at that is there's a lot of what ifs out there, right? Well, we don't know what we don't know, right? So right now, this is what's available to us. And in my opinion, I say take full advantage of this as much as possible. This is what I do. This is my retirement scheme is based a lot around pensions. There's other investings as well, but it's mainly around pensions. So with pensions, the other thing is that once you do retire, you can take out a lump sum of 25% of that pension, up to a maximum of 200,000 euros, right? So 25% to a maximum of 200,000 euros, and that is completely tax-free. So essentially, you could save 200,000 euros absolutely tax-free. So, but you would have to actually have 800,000 in your pension, because it is, remember, 25% that you can take out. Now, there is a maximum as well of how much you can put in. So that max is based on your age. As you can see there, you know, whatever age group you're in, it gets a bit higher and higher as you move up. Okay, so let's just take a quick look at how this works. All right, so let's say you got a 1,000 euros of your income coming in through your paycheck as normal, right? That's going to get hit by 40%. If you're on that 40% bracket, that's going to get hit by 40% income tax. You're looking at approximately another 8% then PRSI and USC. That leaves you with about 52% left over. It can be higher, can be lower, it depends on how much you're actually earning. So that could actually end up being, I think it's 52% total tax, 48% take home. So we're getting hit pretty heavy. Like Alvar said, you know, Ireland is not the best place in the world for taxes and especially for true investing as well. So here's what it would look like if you were to tell your employer, I want 1,000 euros per month put into my pension. So that's an additional 1,000 euros per month put into the pension. So 100% of that goes in, right? You will still get hit with PRSI and USC. That's about 8% again. But your cost to this is approximately 600 euros, right? Because if you didn't put that 1,000 euros into the pension, you would have got hit by that 40% tax bracket, and you would have lost that 40% anyway, right? So it's costing you 600 euros to invest 1,000. That's an instant savings of additional, 400 euros out of your 600, which is actually more than 40%. But okay, and let's move on here. I see the time is flying by. All right, so another investment to go through is the EIIS scheme, or the EII scheme. So what this is a tax relief which aims at, I suppose, encouraging people to provide equity, so financial equity, to qualified companies. Right? So Irish companies can fundraise through this scheme, and they do it to grow the business and to raise capital in order to whatever it is. It's in order to grow that business, right? They can excuse me. They can raise up to 15 million per scheme, right? 15 million total, but there's a maximum per year that they can get out of it, and I think it's like 5 million per year that they can take from it, right? So they take 5 million, invest it, grow it, they can get another 5 million, but a maximum total of 15 million. And this money then, like I said, it can be used for growth, it can be used for new products, it can be used to expand into new markets, construction, whatever it is. So we'll dive into that a little bit here now. The maximum that we can put in as an individual investor is 250,000 in an individual year. Now, if you go up to 250,000, you have to keep that money in there then for 4 years. And the way that why this is tax friendly is that you can then claim back your tax out of that. So if you're on that high tax bracket, so that let's say that 40% tax bracket, and in this example here, as you can see, you put in 10,000 euros, you can claim back 4,000 euros out of that straight away. So essentially, you've got 10,000 euros invested in a company or a fund, or a EIIS fund as well. So you got 10,000 euros invested, right? It's only costing you 6,000 euros because you can get that 4,000 euros back straight away. As soon as that money is invested in, you can claim that 4,000 euros back. So obviously, these are not guaranteed in any way whatsoever. You're not guaranteed to get profit out of it anyway. You will still yield the tax benefits though, right? So there's there's no security, there's no personal guarantees, there's no there is a risk that the company could go bust even, but it's investing. It's part of the risk, I suppose, that you have to take. And again, like I said before, your money is tied up as well for minimum 4 years, so you do keep that in mind as well. Right, so claiming that tax relief. So if you're any one of those 4 at the top there, either PAYE, even on rental income. So if you're a property investor, you can claim that back as well based on that. And claiming that back is just going onto the website. You can the revenue.ie website. All right. Just a few little things here that I wanted to point out was that you do it on your Form 11. Any unused taxes. So let's say you can claim whatever, let's say 4,000 euros back in the year, but you don't owe 4,000 euros of taxes. You only owe 3,000. That extra 1,000 can go to the next year. Okay, so you can, like I said, you can invest in either individual companies or in a fund as well. So a fund, what it does is it invests in 5 or 6 different companies, and these will be larger investments, 5 million each or so. Just wanted to point out this one here. So this is Davies. These are the past EIIS funds. So what we're seeing here in the bars are what people received back as a gross amount, right? So, and then as a net amount was the orange bar, right? And then the red one, then this is what they received back, taken into account the tax relief as well. So you can see the tax relief, yeah, was up there. It's about 40% extra they got. Up here, it was almost 70%. This one here was down to below 20%. But if you were not taking in that tax relief into account, this is actually how much people received back, was less than 100% of the money, except for this one, 2013, where they got 111%. Okay, so you can see here, you know, if without that tax relief, you don't get a huge amount back. And I started thinking about that and analyzing and wondering why. And I think the reason why is that the brokers that are doing these funds, they don't really need to worry too much about giving you a good return back, because you're getting that return from your tax relief. So they're going, well, look, you earned 172% in 2013 funds. Maybe that's the reason. I don't know, you know. But again, the tax relief is what's making it, right? Some of the risks here, like I said, your money is tied up 4 years. You may not make a substantial profit from the company, but you do get it from the tax relief, and there's no security or personal guarantees there either. Right, moving on then, forestry funds. This is another one that's been going for quite a while now, actually. So these are what I'm going to talk about here is more about the funds rather than purchasing land and growing your own forest and things like that, because it does tend to get very complex when you start looking into things like that, right? So you know, farmers do get they get grants for growing the trees, like the initial set and things like that, right? But for the funds, basically what the funds do is, of course, they have money coming in, and then they use that money to buy land and to grow those trees or whatever it's going to be, right? Either there's different types of trees as well. You get different grants based on what type of trees you have, and so what these funds do then is when they get that grant money coming in every year, that grant money then gets distributed out as shares or as dividends then to each of the investors. And then at the time of maturity then, which is usually about 15 years, they'll sell off the trees, and then there's a lump sum coming in. Now, there has been, you probably already heard about this in the news, where there has been a fund that didn't provide as much return as people were expecting, and they put in a lot of money into it and was expecting a lot back, and they didn't get back as much, right? So I suppose a bit of caution there. Make sure that you research these companies and these funds, and make sure you know what you're getting yourself into. So here's the normal structure, the way it's normally set up for these as a fund, right? So it's usually a limited partnership. The asset would be the land or the actual forest itself, right? So when you invest, you actually receive shares in that limited partnership, and then there's that annual distribution of grants. You're usually not locked in. You can transfer those shares if you can sell them. Sometimes it's difficult to sell them. It depends on the liquidity of it and how much it's actually making. I've noticed the management fees are quite high. There's also setup fees, and sometimes there's exit fees as well. So again, research that. Make sure that you understand all the fees that are in there before putting anything into this. So the reason this is tax efficient is because the money that you get back, that grant money that you get back, is tax free. So you're tax exempt. So you do not pay any taxes on that income whatsoever. The profit that you make, so when they sell those trees and you get that profit at the end, you do pay PRSI and USC on that as well. So so watch out for that. I think from what I've been reading, I couldn't quite understand whether you pay PRSI and USC on that grant money coming back. Not 100% sure about that. I don't know. It was hard to determine, even from looking at the revenue.ie website. I still quite couldn't get it. I wasn't 100% sure. I'm sure one of these, if you've called up these forestry funds, they'll tell you as well. Let's see. I just want to make sure I got covered all my points that I want to cover here. Yeah, so the company, basically, when you invest in a fund, the company does everything for you. So you don't have to go out and start taking care of the trees or trimmings or anything like that. They do everything, right? So they'll set up all get the permissions for the plant. They'll do the actual planting. They'll maintain that forest. They'll get the trimmings down and all that stuff, right? One thing that you will notice, and let me just show you an example here, is nearly all the websites you go to, they'll tend to show quite high returns. So I would take these with a pinch of salt, mainly because of past experiences from what I've heard. But again, I'm not putting this down in any way whatsoever. But do keep in mind that these things. There's salespeople basically, right? So they want to sell these investments, right? So they want to get more money in. So this is one here that from sif.ie. So here they're saying that for 10,000 euros you can expect back about 14,000 plus this 510 every year as well. So it's a 15-year investment. So this is income. This is 510 per hectare, right? So the more hectares they have, then there's obviously the more money they'll get back. All right, the next one to go in. Let's see, what time are we? 10 after. So risks on that one then, like I said, is a long-term investment, minimum 15 years, but there is a liquidity there for that, the resale market. Yeah, that's the other thing is, what I noticed is the grants don't seem to increase. So remember, inflation is coming in at about 1.7% per year here in Ireland, right? That 510 euros per hectare this year, yeah, that might sound good, but in 15 years, 500 euros, it's probably not as much as it used to be. Just like, I suppose, like if you look at 5,000 euros 15 years ago, yeah, you could have done a lot with it. 5,000 euros now, it's okay. It doesn't do a huge amount anymore, right? So keep that in mind as well, right? Inflation does hit those grant payouts. So some of the other risks then is the fire, the wind, pestilence. So they do tend to take out forest insurance for that. Again, it's something you should check before you put any money into a fund. Make sure that they are taking out insurance. And the other risk as well, and I think this was one of the issues with that one company that has been in the media or was in the media, is that once they got to that 15-year marker and they sold off that wood, they didn't get the timber price that they were expecting, and that's why people didn't get back as much money as they thought they would get back. So that's another risk there, right? All right, moving on to the last one now. So the rental room scheme, love this scheme. All right, so this is something I do myself, and basically the way it works is that you can rent out a room in your house, or 2 rooms, 3 rooms, whatever you want to rent out, right? And you can do it absolutely tax-free. So as long as you live in your home, it's your own home, you live there, you don't have to own the home. You just has to be your home. So you could actually rent out an entire house. As long as you're living there, then you can do this, right? So you can get up to 14,000 tax-free income from this. And now be careful here. If you make 14,001 euro in a year, you're going to get taxed on the entire thing. So do not go over that 14,000. You still need to claim it in your taxes. So if you're filing your taxes at the end of the year, you just jot down there how much you actually made in renting out your rooms, but you do not get taxed on it. You just have to claim it. That's all. All right, so that was the pros on it. Now let's take a look at the cons, right? So it is challenging. You know, everybody has their own little quirks, right? So living with other people is challenging, definitely. You do lose your privacy, of course, because you have to open up your home to other people. And like I said, you must live in the house. You can't just rent out a house and be living someplace else and then renting out the rooms there. That doesn't work. You cannot charge, or you're not supposed to charge extra for bills, right? I've seen people do this, but you're not supposed to. It's for this rent a room scheme anyway. If you're on this rent a room scheme, whatever you charge the tenant is supposed to be a one price, and all the bills are supposed to be included in that. The other part of that, it must be part of your main residence. So if you've got a granny flat, or you've got a little shed out the back that you're thinking of putting a radiator into, that's they're going to say no to that. All right, so we went through quite a lot there. We went through the pensions, so AVCs on the pensions. We went through the forestry fund. We went through the EIIS scheme, and we went through the rent a room scheme as well, right? So they're the four main ones that we have here in Ireland. Well, it's actually the only four that I found anyway in Ireland. There might be some other schemes out there, but they're definitely not advertised too well anyway. And like Albert said, you know, there's the taxes here in Ireland are pretty steep, they're pretty heavy. So take advantage of these if you can. One of them, two of them, all of them, whatever, however you're going to do it. Okay. All right, so that's me. So like I said, I have founded and I run the Financial Independence Ireland Meetup group. If you go to meetup.com, do a search for Financial Independence Ireland, you'll find it there. We meet once a month, and then I run the website then as well, ignitemyfire.ie. So please feel free to visit that. All right, thanks everybody, and over to you, Dave. See if there's any questions.
Yeah, yeah. Thanks, Vince. You know, that was fantastic, and you know, I actually love hearing you present. And you gave a nice mix there of pensions, tax relief, which was the buzzword, and you touched on rent a room and a few other different investment things in great detail.
Oh, yeah, tax relief, tax relief, tax relief.
Yeah, we got that. There's a couple of questions for you, and there was some sent in advance. If you can take a couple before we move into the break.
Yep.
So one of the questions I have, Vince, here is, can you, does employer contribution count towards the max AVC contribution percentage?
The employer contribution count towards the max AVC. Yes, for an occupational pension, no for PRSA. So either the standard or the non-standard PRSA, no. So this is, I've heard this one to be debated quite a lot, and everybody seems to say, absolutely not, that your employer pension contribution does not count towards the AVC maximum contribution percent. But I did talk to the revenue on that one, and they said, yes, it does for occupational pensions. Yes. PRSAs, no.
Okay, perfect. No. Thanks for that. There's another question here in relation to, okay, can you withdraw the investment out of the EIIS scheme before the 4-year period?
You can. You do lose your, you do lose that tax benefit though. So you would have to actually pay back that tax benefit if you've received it. But again, you would have to of course, organize that with either with the fund or with with the company that you invested in. They do frown upon that. The fund themselves sometimes will take their investment back out short of the 4-year period, only if it's beneficial to the fund. So I think it was Goodbodies that I was talking to about that, and they said that they have done it in the past, but it benefited the stakeholder to do that. So they actually got more money back at that time than it would cost in that tax relief. So it worked out better for the stakeholder.
Perfect, Vince, thank you. There's one in here for Mel, and it's a bit similar to one that came in previously, which is, what are the different age thresholds that you can access the different pensions? There's different types of pensions outside of the state pension. Mel, for example, he was asked, how can you access a pension, let's say at age 50? I thought most pensions were age 67. I mean, that's specifically a state pension. But what are the thresholds of age, and when can you access these, Vince?
Yeah, so you can access a pension at 50 if the company that you're working for allows you to retire at 50. So it is possible to do that, to access that. Yeah, the state pension is 67, I believe now. It's supposed to be going up to 68. But normally you would get your pension from 60 onwards, I believe. Again, it's something that, like, always feel free to call up Revenue about any of these, because I've called them a few times now, and they're actually really good on the phone. They're really friendly. They don't start asking you any personal questions or anything like that. They don't usually even ask your name. They just, they just help you out. So, if you ever have any questions along those lines, yeah, jump onto the phone and call Revenue up and just ask them, and they'll answer that. But yeah, I'm not sure if I answered that question fully there for you, but so 50, you can, I have seen and I have read that you can start pulling your pension out at 50 years of age. And of course you have to go through the process, right? You have to either put it into annuity or an ARF, but you can access it at 50 as long as the company that you're working for allows you to retire at 50.
Okay, perfect.
Does that answer the question there, Dave? I'm just not 100% sure I answered.
No, I think so, and I think the idea is that there's different pensions out there from what I can see, and yeah, I know myself of some people specifically who maybe buy a bond or something like that, and then they can access that 50.
Yeah, there's PRSAs, which is like a personal pension that you can open up. Those ones, I'm not sure if you can access that at 50 or not. Not 100% sure. So those are personal pensions. There's the executive pensions and things like that as well. Yeah.
Perfect. Okay. Well, that's great, and I appreciate that. What we will do is I'll just look to the chat and see if there's any more questions. In terms of Revenue, by the way, I found Revenue very good as well. They actually not great answering the phone at the moment with the pandemic, but you can access them, sending a message through the website. They're really fast. They come back like within an hour, I found. So yeah, they're pretty helpful. General questions, Vince here to everyone. As a company director, if I start withdrawing my pension, let's say from 50, can I decide to go and get another job a few years later? Or would I need to stop pension withdrawals? That might be a specific question, but any ideas on that, Vince?
I don't. I would assume that once you start, because when you retire, you have to take your pension and put it into either annuity or an ARF, an ARF, right, or an ARMF. Sometimes it depends on how much your pension is. So basically, once you put those in there, if you have an annuity, you can't get it out. That's it. It's in there, right? There's no stopping it from there. With an ARF, I believe you can move it around. Then you can move it from an ARF into annuity, things like that. But that's about all you can do with it. So I'm not 100% sure of whether you could do that or not. Whether you can just start retirement and then stop it and start it again later. I don't know. I'm not sure.
Perfect. Okay. Well, look, what we might do, Vince, is I've just reclaimed host control. Thanks so much for the presentation.
Okay.
I appreciate that. I'm just going to share my screen now for a moment. Thank you, Vince. And